Wakey, 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 wakey. It's time for school. Come on. Wake up. It's time for school. Come on, man.
Hello and welcome. If you've been here before, welcome back, and thanks for clicking. Now, let's get started. The S&P 500, simply put, is an index, one of many ways to track the stock market. And the S&P 500 tracks how the top 500 companies in the US are performing, similarly as to the Dow Jones follows the top 30, what are called blue chip companies. Some of the companies in the S&P 500 include massive companies, some of the biggest on the planet. Companies like Apple, Microsoft, Coke, Amazon, Google, Tesla, and Johnson & Johnson, JP Morgan, and Visa, just to name a few of the 500 in the index. All very familiar companies to many of us, with the S&P 500 representing roughly 80% of the stock market value. It's looked at by many investors to be the best gauge of the overall market. The initials in the S&P stands for the Standard & Poor 500. The S&P was founded on March 4th, 1957, 66 years ago at the time of this recording. But as history goes back much further than that, in 1860, Henry Van Poor, an American from Massachusetts and financial analyst, wear the letter P, and poor comes from in the S&P 500 name. Poor formed the publishing company Poor's, which published an investor's guide to the railroad industry back in 1860. And then, in 1923, a company called Standard Statistics, where the S comes from in the S&P 500 name, Standard, the company began rating mortgage bonds and developed its first stock market and index, having the stocks of 233 U.S. companies, and it was computed and updated weekly. But then, just 3 years later, in 1926, it was updated and computed from weekly to daily, but with just 90 stocks in the index from 233. And then in 1941, Poise Publishing merged with Standard Statistics Company to form Standard & Poor's. And then finally, it happened on Monday, March 4th, 1957. The index was expanded to its current 500 companies and renamed the S&P 500 Stock Composite Index. Wow, that's a lot. I'm glad we call it just the S&P 500 now, or just as is commonly known as the S&P for short. Something massive happened for the S&P 500. In August 1976, the Vanguard Group offered the first mutual fund to retail investors that tracked the index, that tracked the entirety of the S&P 500. This is great for retail investors because sometimes, as a retail investor, it can be daunting investing. So investing into the S&P 500 can help simplify things, because if you believe in the US economy and some of the largest companies in the world, such as we spoke about earlier, like Apple and Google, it makes it easier to invest without having to learn too much about the market in such detail. Well, Vanguard sure did simplify things by creating the world's first mutual fund. More development and popularity came in the 1980s, with exchanges adopting trading what are called contracts or futures of how good or potentially how poorly the S&P will perform, with the Chicago Mercantile Exchange, a global marketplace located in Chicago, Illinois. Chicago Mercantile Exchange, the global marketplace, began trading on what are called options, which allows investors to become potential buyers of a stock. the right but not obligation to buy or sell a stock at a specific price on or before a specific date, which doing then popularized the S&P 500 index even more amongst investors. Then beginning in 1986, the index value was updated and had an upgrade, and was updated every 15 seconds, or roughly 1,559 times per trading day, which a trading day consists of 6.5 hours a day, from 9:30 in the morning Eastern Standard Time to 4 p.m. Eastern Standard Time, Monday through Friday. But the following year wouldn't be so great. We saw what is known as Black Monday. On Monday, October 19th, 1987, the largely unexpected stock market crash, the index realized its worst daily percentage loss, falling 20.47% in a single day. The index sure had a lot of milestone years, some being amazing and some being absolutely horrible. But for now, let's stick with the better years for returns for investors in the S&P 500 index. With the best year for returns, total annual returns, including dividends, being 1995, at a return of 37.58%. And the second year for returns being 1975, with a return of 37.2%. With ironically 1974 being the third worst year with a 26.4% return. The third best year for returns for the index was 1997 at a return of 33.36%. The mid-90s sure had some massive growth, which what I believe had to do a lot with the dot-com boom, with already mentioning the third worst year in returns was in 1974. The second worst was 2002 at a negative return of 22.10%. And the worst being in 2008 with a return of negative 37%. Wow, it was a volatile time. From 1995 to 2008, we had many ups and many downs, from all-time highs to all-time lows in returns. The companies and the company stocks of the S&P 500 are handpicked and selected by a committee. When considering for eligibility to become an addition to the index, it becomes rule-based. The committee assesses the companies by using a criteria of things including and having a market capitalization or company worth of at least $12.7 billion US, rules on liquidity, how many shares are on the public float, aka how many shares exist and are traded. Another criteria being a minimum monthly trading volume of 250,000 shares, must be publicly listed on either the New York Stock Exchange or the NASDAQ. The company must have its primary listing on a US-based exchange and be subject to US security laws from the SEC, the governing body of the financial markets. Each company must also derive at least 50% of its revenue in the US, just to name some of the criteria necessary to be listed in the S&P 500 index. There are several ways to invest in the S&P 500, which one of them were mentioned earlier as a mutual fund, which we will have a video explaining mutual funds in the future. Another, for example, is what is called an ETF, which stands for Exchange Traded Fund. So you are able to buy the S&P 500 as a single traded stock and buy them in shares, which means you're a little bit in more control of, say, than of a mutual fund, and more in control of than, for example, a 401k. Some examples of the S&P 500 ETFs are Vanguard's VOO ETF and the SPY, known as the SPY, which we will also be explaining in future videos about ETFs, mutual funds, and 401ks. But remember, none of this is financial advice, only financial entertainment. Well, there you have it, another episode in the books. Have a good morning, a good afternoon, and a great night. Thanks for liking, thanks for subscribing and sharing, and we'll see you in the next one.